begin, we'll optimize the first model, which is the base case model. And when we are done, I will indulge that the team grants me just 5 minutes of your time, just 5 minutes, right after the first model is optimized. Just grant me 5 minutes, and then after the 5 minutes, we will proceed with the rest. Just a moment. Let me even see whether what I want to do within that 5 minutes. I think I have a bit of a challenge here. Just a moment, please. Just 1 minute, team. Just 1 minute, and I'm checking on something. I want to see if something quite popping up on my laptop just now on my desktop, and I don't want it to disrupt the flow of the lecture. I think I'm still checking something, but whichever way, today, I believe you have a great time. You have our model balance. So guys, what we do is that it grants me maybe 2 minutes while we're on the line here. Let me address the issue quickly so that I don't have to take the 5 minutes again I mentioned earlier. So if you just grant me that 2 minutes to address the concern I want to address. Let me see. Let me see something quickly. If maybe you can put in a chat, just 2 minutes. I'll finish within just less than 2 minutes.
Yeah, sure.
So,
Everywhere you find yourself, ensure that you put in your best, because when that opportunity for the bigger one comes tomorrow, it is those experiences in those small opportunities that would really determine how well you do on that bigger one. So my name is Emmanuel Ejam. I'm an associate with Adenia Partners. So I studied in Bachelor of Commerce at the University of Cape Coast. After my internship, I discovered private equity. This is what I've been looking out for, that career that marries my two strong interests, which is basically finance and entrepreneurship. The CFA program is the mother of all finance programs. Every finance profession finds something in there that they can learn from. No matter where you sit across the finance spectrum, you find something in the CFA curriculum that is quite relevant for your careers. I typically tell people that I'll divide like the CFA curriculum into 3 parts. things like understanding financial statements, analyzing them. So that is the directly applicable part of the CFA program. The second part for me, which is understanding of the macro environment, interest rate, inflation, unemployment, and how all of these things can affect the businesses I'm looking at. One of the things the CFA does for you is it introduces you to the diverse perspectives versus a very narrow thinking perspective. For instance, you do behavioral finance in CFA. The first thing that I did was to speak to people who have done the CFA curriculum. The second advice I got, which was quite helpful, was practice, practice, practice. It's very important to understand how you study. So for me, I like visual content. I had to leverage on third-party training providers that have visual content that I could use. I used that throughout all the levels, and it was quite helpful in understanding the concepts quickly. So the CFA program is very well respected across the globe. Its recognition, everyone sees it as the topmost finance certification you can get. It opened doors. I think they looked upon me more favorably than before because of the CFA charter. At the end of the day, these are the networks that will bring you opportunity.
All right, beautiful. I'm back in full force, and good evening, everyone. Good evening, everyone on the call. How are you all doing? So now is here Tony, Sam, Sedinam. Let me see. I'm not sure I saw Sedina yesterday. Oye is here. Oye, I didn't see you yesterday. Nelson, Michael, Francis. Francis, I didn't see Francis yesterday. And I saw you yesterday. Sifas, I didn't see you yesterday. Right, number of people that I didn't see yesterday. Great. How you doing? And how was the day? I hope we all had a great day. Good. Let me just go straight to share my screen. So we begin. Quite a number of things we need to do today. I'm going to close on time as much as possible today. Yesterday I didn't close on time. Today I'm going to close on time. I'm going to Julius. Oh, great. Nelson, good evening, Julius. Stressful day, but we are good. Yourself? I'm also good. I'm doing so well by God's grace. And I had a unique day out today, but I have to rush and leave there so quickly. I could prepare for today's session. I'm happy to have you all here today. Now, let's recap on what I've been doing. I think there's a message in there. I'm in Togo. Okay, Francis, great. Hi, Togo. Hope you're having fun there. Wonderful. Now, recap of how we did yesterday. Yesterday, we put together the model. If you can see my financial model here, we put together the balance sheet, P&L, cash flow statement, but we did that very late, right? I'm sorry for yesterday. And we have a difference. So the balance sheet is not in balance. So activities for today. Let me find a place and list the things we are going to do today. And so we'll be checking them one by one. By the time I'm done with them, then we are done for today. So I think let me list them where. Maybe let me list them on the live worksheet. The number one item we're going to deal with today, we're going to balance the base case model. That the first thing we'll do. The second thing is that we optimize the base case model based on some model objectives. Then the third point, what we'll do today, is that we will also update or we'll formulate best and worst case scenarios, scenario assumptions. Okay, so what happens is that we're going to formulate assumptions for the best and worst case scenarios, and well, and intrinsically, let me say, and optimize the respective models. So we'll do that as well. And so these are the objectives for our work today. The first thing is that we should be able to balance the base case model. The second is that we optimize the base case model based on some model objectives. And the third one is that once we've done optimizing a base case model, then we'll go ahead to formulate best and worst case scenarios, scenario assumptions, okay? And then build based on that, you have the base case model too, and the worst case model, and have those ones also optimized. So we have not quite a lot because of how I design my workbook. We are not going to struggle in doing all this. It looks like a lot of things to do, but not really. Let's take the first one. Let's work on the first one. So the first one is we should balance the base case model. Now, so far, let me just take you back and provide maybe a summary of what we've done. Okay, on what we've done. We built three assumptions, three sets of assumptions: base case, best case, and worst case. But the input in these assumptions are basically that of the base case, right? So we are going to build a model on the base case. And then once we finish that, we will just adjust the assumptions in the best and the worst. And then we have a model for that as well directly. Now, what we did was that we created this we call the life. This is the live assumption sheet, and we link each of these scenarios to the live. So when we alternate, or when we can switch between various scenarios here, we can switch from best case to base case, put it on base case, the things will change, put it on best case, things will change, put it on worst case, things will change. Now, the best case, worst case, and base case all have the same values. That's why it's appearing as those things are not changing. By close of day, we will be able to see the various scenarios, or we will be able to see when we use the drop down button, you'll see how the rest also change, right? By close of day, you have all that's done. So that's what we've been doing. So we link the model itself to the live worksheet. So the live worksheet, you are not going to make any input there. So if you check the live worksheet, for example, you check this, you see the formula there. We use the switch function to build a model, right? Now let's work on this. When we did this, our balance sheet didn't balance. Oops, that's bad, right? Our balance sheet didn't balance. Let's check it out. So this is our balance sheet. We have some difference here. Not significant, but it's a growing difference. And I'm happy that my balance sheet didn't balance last night. In fact, we didn't even try to balance it. We just stopped there. The balance sheet didn't balance, and I'm happy. I'm happy that the balance sheet didn't balance because it will help me to show you some few things as well as to how we check errors for errors. Now, I want you to see something. When I was building this, I ensured that I didn't make any adjustment. Let's look at the equity section first. I didn't make any adjustment to other reserves. I intentionally kept it like that so that if I have errors in my account, I'm able to check it out to see the source easily. There are no movement to other reserves, of course, which even if I'm doing forecasting or projections, I will not consider that. Fair value reserve is constant. From 2024 going, it's been constant. And I'm happy it's constant. In fact, I don't even intend that is changing. Maybe let me free spin here. So I go to view, go to, why is this thing not still at view again? Maybe, no, it should be at view, right? It's been a long since I free spin. Okay, it's here. So let me just free spin. Okay. No, I want this to free spin in this region for me. I want to be able to go. So I'll go back to my view and then I freeze. I come here and then I go back to view again. Where is my free spin? I want to keep the rows and columns visible while the rest of the worksheet scrolls. Yeah, that's what I was doing first, right? Okay, let me rather put it here. Yeah, so go to view. Then I go to freeze spin, I freeze it. Okay, this is working well now. Good. Now, so when you check, let me close this. Okay, so when you check the figures we have here, other reserves is constant across, so that cannot be the reason why our model is imbalanced. Fair value reserve is constant across. That cannot be the reason. So we are taking some stuff. Credit risk reserve, because we've not done any movement into this account, they are all constant. Okay, so it can be the reason why our model has problem. This is statutory reserve is constant. So there's no reason why we can say this is the problem. Retained earnings, oops, it's been changing. Settled capital is constant. Retained earnings is been changing. Let's see whether we can reconcile retained earnings. When we go to retained earnings, which is under equity, what do we see? We see the movement in retained earnings over a forecast period is simply the profit for the year. We can all see it here. It's the profit for the year. Since it's the profit for the year, let's see whether on the face of the balance sheet, we can reconcile the retained earnings. So if I take the previous retained earnings, previous year, if I add the net profit or the profit after tax to it, I want it to give me the current one, right? So let me put it under here. I take the previous, then I add the profit here, and I want it to give me the current. So let's check. The profit for the year 2025 is 1.1 billion. When I do it, it gives me this figure. So I can drag it across to see whether it's consistent. It appears this here, highlighted in this color, is consistent with this here. So it means that my retained earnings is consistent. So that cannot be the source of the error. So entire equity cannot be the source of the reason why my account is not in balance. Let's proceed to liabilities. And a liability, let's even look at the error magnitude, 430 million, because everything is in thousands. So 430 million. 430 million. Look at the movement in deposit from banks. It's just about 611. So this cannot be the reason why we have error, because 430 is a bigger error, right? You don't have to waste time on things that cannot be the reason. Second one is deposit from customers. Oops, this can potentially be the reason, because if the figure or the difference in question is large, but since it's very large, sometimes it could even not be the reason, but let's just take it out. We made a simplistic assumption that the interest accrued on the deposit is the same interest paid. Therefore, we don't have those accruals. In other words, the movement in deposit completely reflects the total value of deposit mobilized in the period. So if I take the deposit at the beginning and I add the deposit mobilized in the cash flow statement, I go to the cash flow statement, I'm looking at operating assets. And the operating asset, I'm looking at deposit mobilized from customers. Oh, I have it. Here is it, 10.4 billion. When I add it to it, I must get a deposit for the year. Do I have that? 44.9497, 44.497. Good. It's consistent. It means deposit cannot be the reason why we have error on the balance sheet. Right? Good. Now let's move to borrowing. With borrowing, let's take it out again. The same methodology. We take the previous, then we add any additional borrowing on the cash flow statement we've calculated. Changes in borrowing, we locate that. We add the changes in borrowing in 2025. It gave us the total borrowing in 2025, 3.1 billion. 3.1 billion is consistent. So it can be the source of error. So we are eliminating some things. I know current tax liability and employer obligation, the figures are small. So they can be the reason why we have errors here. So I'm even jumping them all together. Other liability, look at the movement from 2024 to 2025, from 955 to 1.106. The difference is not significant. Therefore, that cannot be the reason why we have error. So in other words, I've certified that liability cannot be the source of error. Let's go to assets. Now, if you see property, plant, and equipment here, or property, equipment, and ROU, let's take it out to see whether that's a source of error. If I take the property, equipment, and ROU in 2024, this is what I want to do. This is the balance in 2024. During the year, some amount of PP is expected to be purchased. So let me add that to it. Now I'm going to subtract it because I'm going to find that figure in the cash flow statement. And on the cash flow statement, that figure is a negative. Let's go to investing activity. Investing activity, I'll see purchase of property, plant, and equipment. And it's a negative figure because it's a cash outflow. But because I want to add it to the beginning value of property, plant, and equipment, I subtracted it. So if I do negative of negative, that's positive. So this is actually the total value of property, plant, and equipment. But depreciation was charged on property, plant, and equipment. But let's look at it some way. When we go to the P&L, the depreciation I have has been added together. We have depreciation and amortization expenses. So both the depreciation of PPE and amortization of intangibles have been combined here. So if I want to do this analysis also, I have to add both together. So what I have so far is the beginning balance or net book value of PPE plus the addition to PPE in the course of the year. Now let me do the same for intangible as well. The beginning balance of intangible is this, and I need to also look at the PPE for intangible. That is the total CapEx budgeted for intangible asset again. I go to cash flow statement, I look for PPE, purchase of property or purchase of intangible asset. I have it here, negative 60598. But because I want to add it, I subtract it. So when we do that, it gives you 922,446. Now, we can now go ahead to subtract the depreciation for the year. When we do that, we expect that the closing balance should be the same as the balance on the balance sheet at the end of 2025. So we need to subtract depreciation. But if you want to subtract depreciation, since depreciation is already negative on the P&L, we just add it. This is the depreciation we place in there. There's something fishy here. Let's take it out. We got 274,212. So this should be the balance of the assets if things are done properly. But let's see what the balance of the asset is. The balance of the asset is the sum of the intangibles and PPE on the balance sheet December 25. When we do that, oops, that is 705. It's supposed to be 705. You know, there's difference. We try to reconcile the two, and the two are not aligning. Let's see the difference. 705 minus 274,212. Oops, look at the difference. Exactly the difference. You know, you may wonder, it's exactly because the difference is just one, right? Let's drag this. Let's drag this throughout and see. Let's drag it throughout the years. Now let's drag the difference too, the difference of that too. Okay, now let's look at the difference in the difference, or the difference in the difference. What I mean is that the error here, we are looking at the differential error, or the difference in the error. The first error is this, so that corresponds to this. The second difference is this. That corresponds to this. It appears our problem is with PPE and intangible, how we accounted for it. The third one is this. PPE is a source of the problem. Maybe there's a problem somewhere. Let's check how we accounted for PPE. Let's check the balance sheet. Which values are we picking? Are we picking the correct values? In the balance sheet, we have, on a balance sheet, we have this figure here, 572, that is linked to the fixed assets J28. Fixed asset J28. Oh, it's correct. Fixed asset J28 is supposed to be the carrying amount. So it's correct. It's picking the right figure. Let's check the intangible as well. The intangible supposed to be picking fixed asset J55. Let's go to fixed asset J55. And J55, yeah, it's picking the correct thing. Then what should the problem be? Let's go to cash flow statement. Cash flow statement, we are looking at two things. Where the purchase is done, the addition to CapEx, J39, that's for intangible, and J12 for PP. Let's check it out. J12 for PP. Let's see whether it's true. J12 for PP Yeah, that's picking exactly the intangible, the additions, right? And J and J39 for intangibles. That's also picking the correct thing. So what's bringing us a problem? Let's check depreciation. Cash flow statement. We added back depreciation. Let's see where that is taken from. What we have added back. It's taken from the P&L. Let's check the P&L. Depreciation appear too high because look at the historical depreciation. Look at depreciation in 2025. That alone should tell me that there's a problem, right? This alone should tell me that there's a problem. So I go to the P&L account to check depreciation. And truly, if you study the historical trend in depreciation, you can have something like this. It's just too high. So there might have been a problem. Let's check the formula in the depreciation. So that is J21 plus J38. Let's check it out. J21, J38. J21 is odd. So it's picking a correct thing. So J21 is correct. J38, let's check it out. What's it picking? Oops. Have you seen what's going on? We mistakenly picked the wrong thing. We have gone to pick the opening balance of cost as amortization, which is wrong. We're supposed to have been picking the depreciation charge, or sorry, the amortization charge here, this line, and not this line. So we know where our problem is. Let's resolve it quickly. So we come here, we're supposed to pick J21 plus something. So plus that thing, we go to fixed asset, and what we're supposed to pick is this. We pick it up, we hit enter, and right when we hit enter, something interesting happened. You see, a lot of things have changed. We go to the balance sheet and check, and our balance sheet is in balance. You'll be wondering, if I see our balance sheet is in balance, then where from the 111? Well, these 111s are actually from the historical financial statement. The historical financial statement is not in, it's in balance, but there are some few error. And it's expected because once you have accounts and you have, when accounts are typed, a PDF, the PDF stuff, or PowerPoint or whatever in the document, things are approximated, right? So when you bring them back to SLE, sometimes it may not add up well. So because of the differential in 2024, that differential, which is 1, runs through. So in other words, my model is very correct. I have a correct model now. Hooray, we've done well. We've balanced the model. We balance the model. And that's a beautiful thing. We balance the model. Wonderful. So let's check. We said we have some tasks for today. Let's look at progress so far. Progress so far. Balance the base case model. Have we done that? Yes. So let's check that. That has been done. So green. So that has been done, right? So we have this. Great. Next thing is optimize the base case model based on some model objectives. So we have the model, but this, you cannot just have a model because the model balance. Then you go ahead to say, I'm doing valuation. No, or you just present. No. You see, the model must achieve some objectives. And the model must be consistent with some objectives. If the model is not consistent objective-wise, you are not you are not getting it right, right? So we have a very nice model. We project a very nice profitability. It makes some sense, right? But let's look at that. We said we want to optimize a model based on some model objective. The first thing we need to do is to develop those sets of model objectives. So to do that, I'm going to duplicate this again, sending it to the end. And then I'm going to call this model objectives. Model objectives. And then I want to use the color coding. Maybe let me use this model objectives. And then for model objective, let me duplicate one of these worksheets. I want to use one of them. I'll edit it for my work. I want to call these objectives or financial. Oh, I can just call it KPIs, right? KPIs and objectives, or objectives and KPIs. Or just objectives. Yeah. The beautiful thing with what I do is that I don't do these things down before coming. I do them right here before you. And so if I'm making mistakes, I want to make mistake right here, right? So, hey, I almost deleted something important. Let me delete what we have here entirely, leaving the one at the top. So I'm editing this, deleting all this I have here. And I'm calling this side model objectives. And then the model objectives, what we're going to do, you can call it model objectives or objectives. Let's call it performance measures here. So what we'll do actually, I'm taking off the keygap from here. I don't need a keygap here. Let me move this to this side. I don't need a keygap here in this particular. So I'm deleting the keygap, and all these things should go. Now we're going to do some interesting stuff. We will work with some few things like this. You'll do something like this. I'm going to have bank, and then, so this is the bank, or I can say GCB, and list some set of ratios, and I'll do the same for the industry as well, right? So that's what we're going to do. So I'm going to put ratios like, let's say, loan growth, or maybe deposit growth, customer deposit growth. I have that here. And then I also have loan growth. I can call it loan and advances growth. And here I'm still talking about customer, or just call it loan advances, because that refers to actually the customer, right? I'm looking at those kind of stuff. And then we will also look at, let me see the industry data I have, whether I have total assets. I believe I have total assets. Okay, I have total assets. So I can also include total asset growth. Good. And then we can, okay, so these are the growth. I'll do the same for the industry or top 5 banks as well. I have the same down for top 5 banks. So what we will do is that we are going to calculate the ratios for GCB and also for the top 5 banks. And so let me indent these once, indent these also once, just one time indentation. So I have indented this once. Now, so this is what we're going to be having. You repeat it across some sort of measures. Maybe let's just repeat that across the other set of measures. So from here, we also want to look at another set. So this set, we call it earnings. We do earnings, average earnings yield. Earning yield. Maybe rather not an average earnings yield. Would that really be okay? Yeah, I think it's cool. Earnings average earning asset yield. We have that. That's the yield, the yield on the assets, right? Then average cost of fund, also average cost of funds. And then we will need average net, we don't even need to call it, we just call it net interest margin. So we'll do the same for the industry as well. Now, so these are kind of like, we can call this area margins. And we'll have another name for this area. So there's sort of objectives that we're going to optimize things again. So we can call this growth in asset and liabilities. And then we'll call this one, we'll call it margins or yields and margins. And from here, maybe we can use a different color coding here. We can make these maybe another color. Is the yellow okay? Yeah, I think yellow is not too bad. We do the yellow and do the same thing here, the yellow. Why is what's happening to my Excel before it's just messing up like this? Okay. Okay. So liabilities. Okay. So we have yields and margins. The next thing we want to see, apart from this, is let's see another set again. And here we want to look at some, let's say, asset liability management stuff, right? Asset liability management. So we want to see things like loan to deposit ratio. We want to see things like cash to deposit ratio. And we want to also see NPL ratio, non-performing loan ratio. What else will we want to see? So loan to deposit, cash to deposit ratio. I think with a loan to deposit, cash to deposit, I may also want to see one more ratio here, which will be gross loans plus investment securities. Okay, plus investment securities. I would like to see that ratio. And then I'm wondering, which other ratio will I want to see? Well, I think these ones are cool. As far as asset liability management is concerned, these ones are cool. These ones are cool. Then the next thing I would like to do is that I want to see some efficiency ratios as well. You'll be wondering, this is how we optimize models, right? Efficiency model ratios as well. So efficiency, we want to look at some efficiency ratios. And here, I want to see non-funded income to total income. I want to see, maybe I want to see something like, I think I should have copied this and paste here as well. I didn't do this. And non-funded income to total income. I want to see cost to income ratio. I want to see that. And then I think that should be fine. Those are the two I want to see for efficiency. I want to see that for efficiency. Those are the two I want to see. Then finally, I want to see some ratios for profitability, right? So I want to see some profitability ratio. So here I want return on equity, return on assets. Then I may want to also see the return on equity. Good. Guys, I want to calculate this on, I want to calculate it based on profit before tax, okay? Yeah, so non-funded income, okay. So the next thing I want to see for profitability, I think return on equity, yeah, return on assets, and that summarizes it. Yeah, that summarizes it. So these two is cool. It summarizes everything. So these are the ratios we are going to calculate. And when we have these ratios calculated, we will use them as basis to optimize the model, right? Customer deposit growth. Let's calculate that. We've done all these things before, but I'm going to do it all over again. So if error, going to use this function a lot, then I'm going to go, maybe for the purpose of this work, I want to bring all the financial statements to closer to the objective that I'm working on, so I don't have to be going every now and then to that place to fetch them. So I'm bringing everything closer so that I simplify my work, right? Okay. So I come here and I said, if error, then customer deposit, right? Growth. So I go to the balance sheet and I look for customer deposit here. 2019, I do 2019, this current year, divided by the previous year, minus 1. And if that result is an error, then provide or return not applicable. Then I do for loan growth as well. So for loan growth too, if error, then I'll go to the balance sheet. And this one, the question is, which type of loan am I talking about? Because here I'm looking at gross loan. I'll not go to the balance sheet. I'll go to earning asset to fetch that of the gross loan. So I'm going to go back to earning assets, and that's where I am now. And I'm looking for gross loan. We've done all these calculations before, but I'm doing them again. This divided by the previous one minus 1. And if the result is error, return not applicable. So I have that here as well. Total asset growth. If error, you go to the balance sheet. If error, then so this divided by this minus 1. And if error, return not applicable. That's what is happening. So we drag this to the end. We drag this to the end. So this is what we have. Now, we go to the top 5 banks. Top 5 banks, I believe we've already done those calculations. Let me bring those ones also closer so we don't have to be moving there every now and then. The top 5 banks, let's see the growth in gross loan. And I mentioned something to you that we can only make use of 2020. We can only make use of from 2021, because 2020 is where we have the full years, 2021 up to 2023. So let's just move it 2021 up to 2023. So we come to, that is for loan growth, right? Gross loan growth. So we come to the top 5, 2021 up to 2023. Those are the growth years we can make use of. We can't do up to 2024. Those ones will be applicable to us. Deposits, let's see the year we can work with. Deposit, we can work with all the years. So I go back here and I pick deposit from 2019, top for deposit here, we pick that. Now we have deposit. The asset growth from 2019, I believe we can work with everything. Asset growth. Oh, I've not even calculated it. Maybe I can do the calculation directly. I don't have to waste my time to do it. If error, then we go to top 5 bank, asset growth, this divided by this minus 1. If error, not applicable. That's what's happening. So we have this as well. Good. So we have for assets, and we have done with assets. We move to yields and margins. Okay, yields and margins. Going forward, what I would like to do is that things that we've already calculated, I'll just go and pick them up, right? I don't have to waste my time doing them again. So if you look at average earning yield, if I go to earning asset, I believe I can get an average earnings yield. So I go to earnings asset quickly, and oh no, I'll go to revenue. I'm sorry. When I go to revenue, I can get the yields of earning assets. Let's check whether I can get that. Under interest income, I get average earning asset yield. It is here. So I pick it up right from here, and then I get it. Average cost of funds, I go to cost. So average cost of funds, where I have to go to is cost. So when I go to cost, I'm looking at cost of funds. So time deposit, average cost of fund is at bottom here. I got that one also. Now, the net interest margin. Well, just for the purpose of argument, I want to recalculate this, right? So if error, what do we want? We want to go to P&L and pick the net interest income and divide it by the average of since 2019, we don't have 2018, we don't calculate average, right? So we divide it by the sum of loans and advances. That's 1. No, it can be loan advance on the balance sheet, guys. It has to be the gross loans and advances. So everything must be on a gross basis. So I go to earning assets, and I'm looking for the gross loans, and I have it here. I've divided by the sum of gross loans plus the sum of gross investment. I look at gross investment. I got that also, plus the sum of gross advances to banks. I have that also. So when I do that, it's a formula missing. Yes. I have to say not applicable, and then apply another bracket. I got it. And then for periods beyond 2019, I'll have to use the average. That is in respect of the net interest margin. So what I'm going to do is that I'm going to rework the whole thing again. If error, you go to SPL, you pick 2020 net interest income divided by at the average of. So the argument you pass into the average includes the following. You go to the earning assets, and when you get there, you take the gross loans 2019 plus gross investment 2019 plus gross advances to banks 2019, comma, then you move back again and get a gross loan 2020 plus the gross investment 2020 plus advances to banks 2020. Bracket closed. Oh, bracket not closed. I need to bring not applicable. I don't know why I'm in a hurry or to do that. So I have this here 12.9%. And that's is what we have here for a 12.9% for the first year, and then the rest of the year. This is what we have. Now, it's not a direct thing to just say, oh, to get net interest margin, you should take the earning asset yield minus cost of funds. No, 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 no. The denominators are different. The cost of funds denominator is deposits, right? Deposits and other costs like borrowings and all that. But the net interest margin denominator is earning assets. And the same thing for the earning asset yield. Now, we need to do the same for the top 5 banks, the average for the top 5 banks. So we can quickly do that. If error, we go to top 5 banks, we are looking at the interest yield. So you look first for interest income, which is this, divided by the earning assets. So we have this plus this, bracket close. But again, guys, just to let you know, 2019 is not reliable to me, same as 2024. So even though we are putting in there, maybe just to say 2019 will not be reliable, the reason is that we don't have the gross loan for 2019 completely. And so even if we do the average from 2020, we will not get a corrected. So I'm going to do the analysis, said that I'll use 2020 as a denominator for the first year. And then going forward, I can be doing the average up to 2023. Then I stop there. So I'll do for 2020. So I'll move it to 2020. If error, then I go to 2020, interest income for 2020. Then I'll divide it by the sum of gross loans in 2020 plus investments in 2020. So I'm going to do that, and then comma, not applicable. So this is what I've done. So in 2022, I will start doing the average. So if error, these things can be tiring, guys, but the whole thing is that I need to still do it because I'm teaching, right? Once we are teaching, some of these things, even though they are boring, you have to keep doing them. So the denominator will be that of 2020 investment plus 2020 loans, comma, 2021 investment plus 2021 loans, period, bracket close. Then, oh, I always forget to bring comma, not applicable. So this makes sense now. So I'll do only up to 2023 because of the issue with my data. Okay, great work. Now we have the average cost of funds to do it as well. And when you look at the data we have here, we have customer deposit throughout, and then average the interest expense to throughout. So this is easier, right? So we can start from this 2019, and then we will go there and pick interest expense for 2019 and divide it by the customer deposit. But look, remember that all we're doing here, there's no borrowing. It's just customer deposit. So if you see this to be lower than GCB, it doesn't mean that they are doing something far better. It's just because we are basing this average cost on deposits and not on both deposits and borrowing. I hope that's clear enough. All right, not applicable. But you see, the reason why I'm introducing this industry, even though things are not quite clear, is just for guidance, right? You know. Then in 2020, I have interest expense divided by the average of 2019 deposit and 2020 deposit. Okay, so this, and then my always this thing I have to please not applicable, and then I drag. That's been good, right? Look at it. So around 4.2 to 4.1 up to 4.9. Of course, the COVID year, the DDP period where cost of everything was high, interest rate was high. Of course, that increased to 4.9, drop again to 4.1, and then drop to 3.8. Right, the sector has really recovered. And then net interest margin. The net interest margin calculation will also start from 2020 because that's where we start having credible loan data. Now I'm going to do something really simple here. When I come into this formula for net interest margin, the denominator is going to be the same as the denominator I'll be using for interest margin as well. The denominator for earning asset yield, the earning asset yield is going to be the same denominator for net interest margin. So I'm copying that denominator. So all I need to do is to say, if error, then I'll go to the top 5 banks, and what I'm going to do is that I'll take the interest income, subtract the interest expense, right? Interest income minus interest expense, and then that gives me my net interest income. Divide that by the total I have here, and then once I do that, I bring, and the not applicable is already there. Then I have this. In the following year to the same thing, I copy the denominator. And I come here and say if error. If I'm doing this alone, there are shortcuts I'll be using, but because I'm teaching, that's the reason why I'm trying to take my time. So the interest income, have I made any mistake? Okay. It have to be for 2021. The interest income for 2021 minus the interest, a mistake. I think I made a mistake here. This is supposed to start from, no, it's supposed to start from 2020. So I have to start, change this D to E and change this also to E. So it gave me, yeah, this is correct now. So this one will be 2021. If error, I'll go pick the top 5 bank. I'll take the interest income here minus the interest in expense for 2021. Again, I put that in bracket nicely. I don't want to have a problem with my formula. Then I divide that by the average of, the earning assets. And when I hit enter, is giving me this. Then I can drag only up to 2023. All right, great progress made. The difficult parts are gone. Let's treat some simpler stuff going forward now. Loan to deposit ratio for GCB. Very easy. All we need to do is to look at a gross loan and divide it by the customer deposit. Let's check it out. So I go to gross loan. Gross loan. So this gross loan, and divided by, it must be divided by the total customer deposit. So it's total deposit. So the total deposit in that case includes customer deposit and deposit with or from banks and other financial institutions, right? So we take customer deposit plus deposit with bank and other financial institutions. Those are the two we add, loan to deposit ratio. And then we have this to be 41%. And then this drop to 34 or something. And then we projected this. Look at it. Look at what's happening. You see the downward trend. You see where the problems are. Our forecast is giving us these values. This is the value that forecast is giving us. They are lower than even the 34% GCB had in 2024. And we're actually putting a bank at risk. Okay? Cash to deposit ratio, let's look at that. We go to cash flow statement, or we can just go to the balance sheet and pick cash and divide it by deposits. And the deposit must also be the deposits from banks and other financial institutions plus deposit from customers. Bracket close. So that is 16%. And let's see what happens. Oops, look at this. Look at what's happening here. That is too high. That is too high. It's just rising. These are reasons why the model must be optimized, right? Non-performing loan ratio. Let's take it. Non-performing loan ratio is the same as non-performing loans divided by the total gross loan. And the non-performing loans are the loans I said yesterday are the loans from standard and below. That's standard and below. I don't know if I've done some calculation anywhere, but when we go to the earning assets, I believe I've done some computations there. So here we have we have the loan demarcations, the classifications here by credit quality, but I've not done any calculation. So this is what I'm going to do. I'm going to do the calculations right here. So I'm going to do, maybe I can still bring the if error formula so I can handle any potential error. And I'll say at the top, I need to first get non-performing loans, right? So I'm going to look for non-performing loans. And right here, I look for non-performing loans. And that's from substandard down. So the first one here, plus the one below it, plus the third one here. These are the non-performing loans. And I'll divide it by the total loan stock, the gross loan stock. And the total gross loan stock is this. We can either use this, we can just use this and this. I explained some things regarding those things yesterday. Okay, so comma, not applicable, then we have this. This is a non-performing loan ratio. So this is what we have. Okay. Now, gross loans to gross loans plus investment securities ratio. If error, we go look for gross loans. So I go to the earning assets. We look for gross loan. I look at the actual gross loan here, divided by gross loan plus gross investment securities ratio. We discussed these ratios a lot, right? So that's the reason why I'm not actually discussing them again, but you'll get a refresher when we start optimizing a model to conform to some of these things. The next thing would be to do it for the industry. For the industry, loan to deposit ratio, we have the gross loan just for some years. Let us not forget, we have gross loan here divided by deposit. But as I said, I'm not trusting 2019 figures. So this is something I have for industry and it's fine. But again, you should know that the deposit here for industry do not include deposit from other banks. The reason is that when we look at industry as a whole, those interbank transactions are net off. I don't have cash to deposit ratio, cash for the industries presented here. Therefore, I'm not going to calculate anything here. And non-performing loans, I don't have data on the industry for non-performing loans for what the purpose of what we're doing. Gross loans to gross investment securities, maybe I have that for industry, so I can do that. And so that is if error, then I go to there, then I have gross loans divided by the sum of gross loan plus gross investment, which we have here. And then not applicable. And I have that here. But as I mentioned, I don't trust 2019 numbers because it's not a complete data, so I take it off. Oh, a whole lot, right? Let's proceed to look at efficiency, then we come to profitability, then we proceed to optimize the model. So efficiency, non-foreign income to total income. What is for GCB? I go to P&L account, non-funded income to total income. So what I do, non-funded income includes fee and commission income plus net trading income plus other income. Those are the non-funded income. And then we divide it by total income, which will then include interest income plus fee and commission income plus net trading income plus other income. So that is what we have there for non-funded income to total income ratio. So we have that presented. Cost to income ratio. Here, I want to, maybe here, I will still consider total cost, right? For the top 5 banks, the data I gathered here is less impairment and depreciation. So let me use the same thing. So the cost here doesn't include impairment and depreciation. Those are not part of the cost, my definition of cost here. So in other words, I'm talking about just cash costs, right? So cost less impairment and depreciation. Let's check it out. So those costs will include interest expense plus fee and commission expense plus personnel expense plus other expenses. And to income ratio, because they are negative figures, I put a negative by it so that I change to positive. And I divide it by the total income. Total income is interest income plus fee and commission income plus net trading income plus other income. Okay, so hit enter, and this is what it gives me. Wonderful, wonderful. The next thing I'll do for the top 5 banks as well. Non-funded income to total income. Let's check it out. Top 5 banks. Do I have that? Oh, I think I do. So non-funded income is this divided by the total income. Total income then is the non-funded income plus interest income. And I have it here. So I'm able to calculate that for the top 5 banks as well. And for the top 5 banks, cost to income ratio, and I've already defined what I mean by cost, right? So cost to income ratio will be, go to top 5 bank, the cost, I have it here already, cost divided by income. The income, which is a sum of non-funded income plus interest income. Interest income, bracket closed. So this is what we have for the industry. If I say industry, guys, I still mean for top 5 banks, right? I'm sorry to say that. Let's look at the last side. The last aspect here, we have return on equity and ROA. And I said a return on equity, we'll base it on profit before tax. Let's check it out and see. For a return on equity, basically, I don't need to bring the if error stuff again. We will do the profit for the year divided by equity. So I go to the balance sheet to pick the total equity as well. Oh, I make a mistake. I said I want to pick profit before tax. So profit before tax divided by total equity. 35 in that manner. But you see, in 2020, I can now do average equity. So because that's the correct way, right? You take profit before tax, you divide it by average equity. How do we get that? We take the equity here, comma, the equity in 2020, and that is your average equity. So if you can just drag, and we have the ROE. ROE, I want to base it on profit after tax, right? So ROE, I pick profit after tax, I divide it by total assets. Divide by total asset in 2019. And then in 2020, I'm going to Um, in 20, you know, okay, I'll come back to something soon. In 2020, I'm going to pick the same thing and divide it by of the average of the assets in 2019, comma, and the asset in 2020. There's something I want to do. Yeah, guys. What I want to do is that I want to look at both the pre-tax ROE and the post-tax ROE. Okay. So, in other words, I'm calculating ROE based on profit before tax. I want to also calculate its profit after tax. So the profit after tax one is called what we call the post-tax ROE, right? Let me do profit after tax as well. For profit after tax, we pick the profit after tax and divide it by equity for the year. And then, of course, the year following that, I'm picking the profit after tax again, but now I'll divide it by the average. I'll divide it by the average equity. This comma this. You could see the impact of tax, right? How tax has depressed the return on equity. You can see that clearly here. Now for the banks, we have net profits. The top 5 banks, I mean, we have net profits here. I picked that and I divided by equity. I think I have equity. Oops, I don't have equity. I should have. Yes, I have equity. And that is actually profit after tax. I have just for after tax. And the following year, I have also the profit after tax divided by the average of the equities, this comma this. And this is what I have. Because I have total asset too, I will be able to calculate the return on assets. Let's do that as well. So return on asset for the top 5 banks will be the net profit divided by the total assets, as we have it here. And then in 2022, I'll be able to do the same calculation, but based on average assets. So net profit divided by average assets we have, and that is this comma this. Wonderful, wonderful, wonderful. Now we are done with our performance measures. Having our performance measures here, the next thing that we need to look out for is to just compare the measures and look at some historical performance and see whether our forecasts are sitting within the history properly in terms of some of these measures. So I am going to create 3 columns here. So I'm creating 3 columns here, and I'm going to call this average. I'm going to call this average. I need a color coding for these things, a color coding for this average, and I'll call this minimum, and I'll call this maximum. So the minimum and the maximum are going to give me specific range for my historical performance. Now, so the average here, let me show you something, how some of these things work, right? Okay. So this is what I'll do. So this is what I'll do. I'm going to look at these historical numbers and I'll see whether they sit within. I'll look at the average, and then I'll look at the minimum, then I'll look at the maximum, and see whether my forecast sits within the range. So the average will simply be just to do the average formula, and then I run this through, and this gives me my average, right? I have it up to this side, and then here as well. And so I have my average calculated. The minimum, I just use the mean function, and then I'll do the same for the mass as well, the mass function, to get a maximum growth rate. So if it is a growth rate, I'm looking at the maximum growth rate over a historical period, right? So I do this, and I also copy the formula and paste it here. Now, I think at this point, let me freeze pane. Let me freeze pane this so that I'm able to. So let me freeze pane this. So we go to view, and then I freeze pane this. Okay. So this is what we have. Historically, you can see that you can see how the performance is looking like. But let me do for all. Then afterwards we can check them. So we have this here as well, and then so it's just about copying and pasting in the formula. So nothing much, nothing more, nothing much, nothing less. We copy this also and paste here, but nothing here. But so this is not applicable. Then we copy this too and paste here as well, and then copy this too, and then paste here. Then copy this and paste. So at all times, we are able to get a minimum, maximum, and the average for a period. And then we copy these two and paste here. Wonderful. 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 Work done. Now, so we have everything we need to be able to optimize our model. So these are the things we need to optimize our model, and we have it to optimize our model. So in the next 45 minutes, all we do is model optimization. Now, so let's look at it. We have deposits. If you look at historically, the deposit growth, customer deposit growth sits between 16% and 58%, and it's at an average of 30.3%. And if you look at all the deposits projected here, they all are around the average, right? They've not excessively exceeded the average excessively. And of course, somebody can make an argument that why wouldn't it be around 58 or something like that? Well, we can, it is possible, but let's look at the loan growth. Loan growth historically is 24.9, and we are forecasting 24.3, 24, 24 all throughout. It looks like our forecast is actually at the average. And if you look at the maximum deposit growth and the maximum growth in loans, they all happen in 2024, most recent. It means that the bank could do even further better in the future, right? So it looks like some of the assumptions we are using here are a bit low, right? A bit low. Now, so when you look at issues of customer deposit and loans and advances, let's look at what happened to the top 5 banks. Top 5 banks, 28% for deposit, and what GCB was reporting 30%, then loan growth of 19%, GCB was reporting 24%. If you look at asset growth, almost the same, 28 versus 24. If you look at the range, the top 5 bank range, 15 to 39, GCB 16 to 58. Meanwhile, GCB is the second largest bank, but again, it's still giving us some great numbers, right? Even above the average, right? So what we can do is to check other things. When you are checking customer deposits and loan growth, go and check things like loan to deposit ratio, and more importantly, cash to deposit ratio. If you look at cash to deposit ratio historically, it's been between 13.1 and 41. But if you look at it over the last 3 years, 25.2, 25.8, then 41.7. From experience, this ratio is around, like, if you get something in the 20s, it's fine. 2024 has overshoot, right? The average significantly. So of course, something within the 20s is fine for me for cash to deposit ratio. But if you look at it going forward, it's been really high. And it is high because, or it keeps rising because a lot of deposits are mobilized, but the loans are not created. So let's check it out. The growth in the loans is lagging the deposits. In the industry, a similar thing is happening. But it's also a normal thing to some extent, given that there's still some appetite for investment securities. If you look at the gross loan to investment security ratio, you see that has been constant around 44.3%. Now, how do we reduce the cash down? The cash drag is too much. There's too much cash in the system. We're just looking at something between in the 20%. So how do we reduce the cash? One way we can reduce the cash is invest more in investment securities. And the second one is create more loans. So it means that these loans, we need more loans to be created, right? We need more loans to be created. So we are going to increase the loan growth. And we will also increase, as we increase the loan growth, to increase investment securities, we will reduce the gross loans to, well, let's check something again. If you look at loan to deposit ratio for the industry, that is in between 37 and 47. Well, the objective is to aim higher, right? DCB is between 34 and 41, or they would like to grow this. So they want the loan to deposit to grow. Over the forecast period, it has even deteriorated. At least in 2024, it's 34. It declined from 37 to 34. And it declined so because deposit grew significantly, but not much loan were written. So I believe the bank is going to write a lot of loan in 2025. So we need to push this up in 2025. I think if we can push this up to be above 35, it is cool. Maybe between 35 and 45 would be ideal. 35 and 45, because the industry is 37 to 47. If we can put something between 35 and 45, it's even cool. 35 and 45 is our guide. Let's check it out, whether we can achieve that. Now, so we go to the base case assumption, and that's what we are using. And you want to push up the loan growth. Let me anchor this as well. Let me put this coming in. I want to, I don't know why this keep going this particular way. Let me shift it to maybe one of the, okay. So I want to be able to get my thing and then view. Okay, I go to view and I want to free spin this. So I go to view and I'm looking for free spin. A free spin. No, this is not what I want. View and freeze. So I go here. I freeze from here. So view, then free spin. Okay, good. I can move this now to the top. Okay, wonderful. Now, this is what I want to do. I want to work on the gross loan. I want the gross loan to increase. So there's something I'm going to do. I'm going to bring the loan to deposit ratio here. So I'll be seeing it. And also, I want to bring, let's bring the loan to deposit ratio first. I want to bring it here so that when I change the ratios, I'm able to see where they are. And also I want to bring the cash to deposit ratio. Cash to deposit ratio as well. So I go to objective, and I'm looking for the cash to deposit ratio we just forecasted. Cash to deposit ratio, forecast cash to deposit ratio is this. This is what we have. And loan to deposit ratio, let me bring that one also here. Loan to deposit ratio. Loan to deposit. And we want to put that between 35 and 45. We are comfortable with that, 35 and 45. And we want the cash to deposit ratio should be between 20% and let's say 29% or something like that. So, so when we change the assumption for loan growth, we expect these things also to change, but we want them to be within the range we are looking at. So if we are going to increase term loans growth, let's increase you to 30% the first year, and let's see what happens. I'm coming. Let me go to the live case. Oh, the live case is still on worst assumption. Let me bring it to base case. Okay. A balance sheet will still be in balance. Oh, there's a problem. With a base case, there's a problem. And let me check where that problem is coming from. Guys, just a moment, right? That shouldn't be a problem. But you just check where this is coming from. I go to live. What is happening to live here? Oh, this side. And it's coming from base. Credit quality. What's happening to credit quality? What happened to credit quality? Oh, there shouldn't be any problem with credit quality. Or is it that the formula we put in there, D5, if base case, oh, there's a mistake. Look at this. When I was writing this, I was writing, look, you see the base case, I'm using a lower case for one of the base. Oh, no. Don't think that's a problem. Let me see. Base case, best case, worst case. I'm wondering where the problem is coming from because I'm selecting base case and it's giving me the error. I go to base case and I'm not really seeing where error could be coming from. Maybe just for some reason, let me put in the formula again. So switch, and then I anchor it here, F4, then comma. Then I said if this is base case, then produce, go to base case and give me the figures in base case. Let me do that one alone and see. Yeah, it gave it to me. So what's the problem? The base case. Then comma, if it's rather best case, I don't know what could be the reason why I had that error. Then go to best case. What is best case? What is best case? Yeah. Then go to best case and give me this. Then the next one is, the last one is worst case. These are the things that can just waste your time for no serious reason. I have this also here. So I don't expect this to happen again. I don't expect this to happen again. Okay, I don't expect this to happen again. So my balance sheet is in balance again. All right, so what were we doing? We want to optimize on few stuff, right? So I go to my base case model, and I put some few KPIs at the top somewhere to optimize some few things. Where did I put it? Oh my days, I made a mistake. Let me check if I made, That would be a very expensive mistake if I did. No, I didn't make it. So I go to base case. I go to base case, and that's where I should have my ratios again, cash to deposit ratio, and I have loan to deposit ratio. Okay, so cash to deposit ratio, let me go fetch it again. Model objective, cash to deposit ratio. I have my cash to deposit ratio for GCB, and that is this. And then I'm looking for loan to deposit ratio as well. I go to my objective. I'm looking for loan to deposit ratio, and that is this starting from 32. And then I drag this. I drag this. And let's see what we have. Ladies and gentlemen, this is what we have, and we want to change the few things here and see what happens to this. So let's look at it. Suppose I change the term loan. I went to do the thing on the best case scenario rather. And that's why I have a bit of a problem. Let me move this up, and then let me free spin somewhere here. Maybe somewhere here, sorry. So data or view, then I free spin. So I go to the earning asset. I want to change this. So you don't make changes on the live sheet, you make it here. So I want to make it 30% growth. And let's see what happens. See what happens when I change it to 30%. Loan cash to deposit ratio dropped to 42. Then loan to deposit ratio increased marginally. Maybe let me make 35% to start with. And then, loan to deposit ratio has improved. I want something more than 35%, right? Cash to deposit ratio dropped to 0.40. But then there's something more I want to do. I want to increase the overdraft. Overdrafts have been rising significantly. Let me make it 45%. And that improved to 36. Cash to deposit ratio has improved again. And then staff loan, I can leave it at this rate. Now, loan to deposit ratio is in a region I like. Loan to deposit ratio is cool. Not the ideal one, but it's still good. Looking at the historical trend, cash to deposit ratio, I have to do something more. Now, to do something more about that, I think there's a question. Attention, recording will stop in minutes. You can read by, okay. Don't ignore that message, guys. So 0.236, yeah, I like the loan to deposit ratio. I like it, it's fine. Cash to deposit ratio, I want it to reduce further in the earlier years, and there is something we can do. To do that means we need to invest some cash, excess cash available in investment securities. And that means that the gross loan and gross investment ratio must drop a little for investment securities to rise. That's one. But also the bank doesn't want to keep investing significantly in investment securities. But as it stands now, that's what we can do in the immediate situation we're finding ourselves in. The bank will not be able to just write new loans like that, right? So I'm going to increase the 2025 ratio, or I'll reduce it, sorry, to 40%. Let me see what happened to cash to deposit ratio. Let me bring it here at the top here so I can see what is happening here. When I reduce it to 0.4, look at that. I think there's a problem. If I say 0.4, these are percentages already. If I reduce it to 40%, look at this. Oh, interesting. Now, there is something, an optimization I yet to do again. I've reduced this, and this is what I'm getting. Not too bad, but there are some few things I may want to check. Let me check revenue side. Let me look at something quickly to do revenue. Interest income, 17% is even moderate, right? Very conservative. So I don't think it's too bad. Interest income, but just one thing I want to do is that the interest in the yields will be dropping, right, because of the falling rates. I expect yields to drop. So from 17%, maybe we can go to 16%. And from 16%, maybe we can go to 15.5, something like that. And then we leave it at 15.5 because historically it has been 15.6. That's the minimum. So leaving it here is fine. Let me check some cost items too, because all these things have impact on cash, right? So before I look at the final cash balance, non-foreign income ratio, I think the ratio is fine. The growth rate is fine. Yeah, that growth rate is fine. Nothing much to do there. Coming to cost of funds is even higher earlier with the falling rate. Maybe let's put it on 2024 cost of funds. And the borrowing, the time other deposit too, the rates are dropping. Let's put it on 2024 as well. And with the borrowing cost, which has recently been high, maybe initial one to be at a 22% again, then let this be dropping to maybe 20%, or let's say the average of the 17.8 and 22%, and that's 19. And then let's drop back to maybe the 17, and then maybe the final could be 13, maybe something like that, and it's 13 throughout. Maybe even drop down. Maybe here even it should be the 17, right? Not the average. The rates are dropping, so 17, and then from here we can move back to the earlier 14, 13, and then 10. Or maybe 13, we leave it at the 13 so that it's sufficiently above the time and other deposit. Personnel, and even coming to fee and commission expenses, I strongly think that I know there's a problem with the spelling of expenses. Since yesterday, these have not been looking nice to me. The ratio here has been biased, right? I think let's rather keep everything at FY24 numbers. So that ratio has been updated. Personnel expenses growth rate, 30%, then kick up 18. I think some of these things are rising significantly. If I take average, it is still the same 19% something. Maybe the first year, the average should be up to, I should start taking the average from 2022, and that's 22%, and maybe maintain it at the 22%. And then in 2026, I can now do the average I can assume that it will grow at Kiga. From 2026 going. Other expenses has been growing at this rate. I think the rate is cool for that. Good. Now, some things are looking good so far, right? When you do some of this, look at what is going on in the P&L. Profitability has increased. And it's significant, actually it's significant. We can all see that it's significant here, but there are some, let's look at some other ratios as well, like the cash to deposit ratio and all those things that are actually providing base of some guide, providing some guides, right? Cash to deposit ratio. So we go to look at cash to deposit ratio, which is this. Now, cash to deposit ratio, loan to deposit ratio has improved. Yeah, I like this. This is good. Cash to deposit ratio marginally. So the cash is still here. But then somebody will also argue, right? Let's go to the objectives. Somebody will argue that the cash to deposit ratio, even in 2024, is extremely high. So if it's dropping sharply to 30.6, it makes sense. So why would you want to reduce it further? So based on that, we will just say, well, let's leave it like that. Let's leave it like that. So it looks like it makes sense. It makes enough sense now. Non-funded income to total income ratio. Historically, this is a range 19 to 25, and is still sitting within the historical range, in exception of 2029, where it has reduced. I don't think what happened in 2029 is in place. From 2027, I think this ratio must increase further. From 2027, this will increase further. So I'm going to go to the assumptions and I'll make some changes there. So base case assumption, I'm looking at the P&L side, the revenue side of things, and I'm looking for non-funded income. Okay, so let me bring that ratio there and make the adjustments. These are the ratios. I want these ratios to all be well above 20%. So I want to start adjusting for 2026. So I can put this at 28%, because as the bank grows significantly, we expect some of these things to grow, maybe at 30%. Then here at 30, maybe 33% or 35% growth, so that it catch up, right? So 35 as well, and maybe 36. Or maybe the initial growth could be higher around, because even 2024 is 27%, right? If we make this 28% or the same 27% as the previous year, I don't think it's something which anybody will argue with you. So we maintain this as a 27% for the first year, and the second year, we maintain the same 27%, and then, or maybe make it 32%, right? Then the rest continue in this manner, or maybe 35% initial growth. Then the rest continues in this manner. I think that is cool now. The non-funded income to is cool. Okay, now going back. You see, the issue with the bank's performance is that when you manage this, then the other one changes. So that's how it works. Our loan to deposit ratio is too cool. Our cash to deposit ratio is too cool. It's reducing gradually, and our gross loan to whatever ratio is fine with us. Let's look at our net interest margin. Well, it's quite stable. If you look at historically, it is between 11.4 and 14.4. Look at it. It all lies within that range, right? So we are cool. Now, let's come down to the efficiency ratios to our cool. Historically, between 19% to 25% for the NFI to total income, and that's the same thing we've seen here. Then we have the cost to income ratio historically, and just that has been dropping. The cost has been dropping. Cost to income ratio has been dropping. And if you look at the industries, between 43% and 55%. So maybe we may need to beef up the cost a bit here to be maybe within the same range. And what do? We go back to the base case assumption. And then the base case assumption, we look for cost. And which cost is dominating? So we go to SPL and see the cost that dominates. And there we see the personnel expenses is the dominant cost, followed by other expenses. So we go to personnel expenses in the base case, then I'm going to put the cost to income ratio there as the objective, and that is what we want to adjust. So this is what we have. We want it to be between 50 and 55% or something. So what we do, we are going to adjust this cost here. And if we make this also 22%, it moves to 0.47. And through our 22%, this is what we are having. Maybe because it increased 30% in 2024, let's increase again 30% here. Or let's apply the same growth rate in 2024 here as well and see. That has increased significantly and throughout. And then cost increasing 30% every year is not proper. So let's say from 2026, it will increase by the average of 2023 and 2024. And that is 2021. Then going forward, it increased at this rate, 21%. Coming to other expenses, it has been erratic, right? But I made it 20.6% throughout, which is not too bad. And we are having the cost to income ratio of this. If all is telling us that the bank is becoming very profitable, right? Which is a good thing. And also, when we go to interest expense, right? When we go to interest expense, how do we see under interest expense? Interest expense, we go to cost. Let's see the assumption we have for interest expense. And step by step, we are almost at the end of the optimization of this. 1.4, 1.4, 1.4, that's what we've done. We think the rate, the cost of fund will be dropping over time, which is not something bad. We are thinking it should drop over time. But maybe I can adjust some of the drop rates here, especially for borrowing. And even if you look at time and other deposit, we expect interest rates all to drop because of the economic recovery, right? Maybe we can anchor it at 14%, 14.4% going forward. And so with that, we have the cost to income ratio around this. It looks like as GCB grows, expands, and they are going to be much more profitable before. Because if you look at a return on equity, the after-tax return on equity is 32%, 37%, 38%, 38%, 35%. You realize that actually still sits within the historical range, right? Then the historical range for profit before tax ROE is still consistent. So we have a model optimized. Because in exception of, it's just the return on asset that you see that is outside the historical range, which is not significantly different from history. So it makes a lot of sense. So our base case model is optimized. Our base case model is optimized. Now, let me calculate one more metric. Then we call the base case model a done deal. The metric I want to calculate is growth in profit before tax. In profit before tax. So growth in profit before tax, we are going to take if error, I'll go to SPL. SPL, that's statement of profit or loss. Profit before tax, I take this divided by this minus 1 if error not applicable. Yeah. Up to this. Then to do this, I have to jump and do the same if error because of the columns I've introduced. SPL, then this divided by this minus 1, then if error not applicable. Okay. So I drag that through. Okay. So this is growth in profit after tax, right? Let's see the average. A profit before tax. This is it. The range historically has been this. And not too bad. In exception of the 2022 where the bank made loss, the growth have been cool. And to me, it's not bad. Even looking at some of the ratios like return on assets and return on equity, I think it's really cool, right? So we have our base case model fully optimized. So we have a full model that if we want to do base case valuation, we are cool to go with. And that's going to be the subject for Monday when we do base case valuation. So we have a model completely and fully optimized for our use, as a base case model. The base case model, in other words, is the most likely event. Is the most likely event that will happen. That if the economy remains or is going the way we expect it now, that's how model will be. Now, you can be with me to work on the worst case model and the best case. Now, when I say the worst case model and the best case, you may be thinking we are going to go through a lot of optimization and all those things. No. And you may also be thinking that we are now coming to link some things. No. And you may also be thinking, that, look, all that I'm going to do is just, I'm going to introduce a framework within which we are going to be adjusting the base model to conform to, or adjusting the base model to get a best case model. So those are the kind of framework we're going to be using. So we are going to actually define what we call scenario triggers. So when I go to, for example, the live, I'm able to change, switch between, let's say, base case to best case. When I change between base case to best case, these are objectives. This model for the best case, this is the model for the best case. You may not see the change happening because I have the validation instead done here. One thing we can do so we can actually follow through our model well is to have the validation rather than here at the top. So I'm going to take off the free spin, whatever. Let me unfreeze the pane so that I can do something here. I'm going to bring the validation here. Let me show you how I'm going to do it. I'm copying this row 5, so C5, and I'm bringing it to C5 here. Okay, so we can run it from here. So when I do that, I want to go back to the live again, and I want to go to data validation, and then I want to clear everything here. So I'll clear everything here, and then there's no data validation here. So all I need to do here is to go link, you see there are errors, right? I'll go and link the validation here. I'll link the validation here so that whatsoever is here will be played into the base case. So I'll not be changing it here again. I'll rather be changing it here on the objective side so that I can be seeing the output. So here is on the best case model. Now, if I now having this, I can actually go back to do my, I can now free my spin, right? Freeze the spin. So if I do that now, I have this. Now, I don't know why this is doing this way, but I think, okay, let me unfreeze again and do something. Unfreeze. Then let me freeze. Let me freeze this. Okay. Did view, then freeze spin. Okay. What's happening to me? what's going to happen to me? Please, a moment. I don't know whether because of the quest to get this done really quick. Okay, so let me go to view again and freeze from here. I think I'm still doing it wrongly. Unfreeze. Let me rather bring it to this side. Okay, this should work. This should work now. So freeze. Good. This has worked. Now, so look at what's happening. When I freeze, sorry, when I change the validation, I'm not seeing the, look, I don't have time to be doing, I'm not here to be doing freezing and unfreezing or whatever. Just see what's happening. When I change this, see how the result will change. When I change from best to worst, you see the result have changed. When I change from worst to base, you see the result have changed. Anytime I change it, you see the result changing. You can see the result. So that's how we can run scenario analysis. And another thing I want to show is that when I make it base, look at the balance sheet. The balance sheet is balanced with base, right? Let me make it best. The balance sheet must still be in balance with best. Let's check it and see. Balance sheet is still in balance with best, right? And when I change it to worst, the balance sheet will still be in balance with worst. Let's check it out. Balance sheet is still in balance. So my balance sheet is in balance. All I need to do is just to move in between scenarios. Now I have the scenarios here. Let me put it again on base to start with, okay? It's currently on base. And when you come to the live tool, you see it here on base because it's linked. Good. I want to check out something really quick, and then I need to define scenario triggers. So what I'm going to do is that for the purpose of, let me see, I jotted something somewhere. I'm going to do the scenario triggers, and that is going to be based on the state of the economy. I don't want to write a lot that down, but it's going to be based on the state of the economy. From here, if you want to leave us, I don't have a problem, but you can be with us or you can watch later, because the thing is that it's 7:30, but I want to take another 30 minutes again. I want to take another 30 minutes to complete the other scenario. So we have it set. So when we meet on Monday, our focus is going to be on valuation. That's the whole idea here. So what I'm going to do is that I'm going to create 3 scenarios, or which we already done, but it's going to be based on the state of the economy. Now, so that will be the projections for GDP, if those projections are going to work, and then that is going to be the base case. If the economy is going to outperform the projections, and then that's what we call the best case. If the economy is going to underperform the projection, then otherwise. So the projections around growth in GDP, inflation, then the CD depreciation and all those kind of stuff, right? In actual fact, but this is how I'm going to implement this. I'm going to start, of course, we always start with the deposit. So this is how I'm going to implement my triggers. Quick one. On the deposit and funding costs, this is what I'm going to do. I have my base case already. So I'm going to I have something somewhere that I am going to use as guide. And so I'm going to create one more worksheet. Let me just duplicate one here. I'll call it, and I'm going to position it right by the assumptions, right? I'm going to position it right by the assumptions. And then I'm going to call it scenario triggers. Triggers. I think I've spelled triggers correctly, right? We're going to call that scenario triggers. And so the scenario triggers, let me adjust something here quickly. I'm going to delete this on the scenario trigger slide page. So I'm going to delete everything I have, and I'll show you how I'm going to do the scenario triggering. And it's going to be quick, please. Scenario triggers. Now, scenario triggers. What I'll do is that I'm not going to do it for any particular, maybe have the headers like this again. But what I'll do is this. I am going to be, so on the side of funding, I will have deposit triggers, and the deposit triggers here, I will have deposit dash base case, and then deposits I'll have for best case and worst case. So best case, and then I'll have for also worst case. Okay. Now, with this, all we're going to say is this, and we don't care about the historical figures, right? For the historical, it's all going to be non-applicable because we don't generate scenarios for historicals. Historical is gone, so it's the forecast that we are interested in. So this is what we do. For all the historicals, for all the forecasts, the base case, we are going to add nothing. Okay, so we'll add nothing to whatsoever assumption we build it. Because once we have the base case plus 0%, and that's all we're interested in, we are not going to add anything more to those ones. For the best case, we'll add, once it's best case, what we're going to do for deposit group for best case is that we may add, let's say we will add 5% growth in deposit above the, or maybe 6% growth in deposit, or maybe we can make it 5%. 5% growth in deposit above the best case, above the base case. So whatsoever the base case is, we add 5%. When it comes to the worst case, whatsoever the worst case is, let's just do the opposite of that. We deduct 5%. So we assume that the growth, the worst case will underperform the base case. So this is what we have. This will be for all deposit numbers. For all deposit numbers. Now, the second thing we will do, I said funding, right? We are not going to, we need to also do something about borrowing, because the whole idea is that, so I can do this and call customer deposit. So this will be for all deposit, but we need to do one for borrowing. Now, do we need borrowings? Yes, we may need borrowings. And when will a bank need borrowing? A bank will need borrowings to increase in bad times because they're not able to mobilize deposits. Therefore, they will go for borrowings. Okay, to have some funding, right? So borrowings we have base case, and then we have base case, we having best case and worst case as well for borrowings. So we have here best case, and if you have here worst case for borrowing. Wow, wonderful. Now, so for base case, again, nothing will be added. For best case, there will be a decline in the quantity of borrowings they have. The reason is that borrowings actually cost bank the money. In fact, the interest cost on deposit on borrowing is higher. So if we get in best scenario, we expect deposits to rather rise and borrowings to decline. So even in some cases, the rise in deposits, we can even move it from 5% rather than to make it 10%, because in those worst cases, or maybe 6%, sorry, because in bad times, we expect to rather, in good time, we expect to rather have deposit, and we expect to have deposit and then not to borrow much. But so in best case scenario, we expect deposit to decline by 5%. A best case scenario, sorry, we expect borrowing to decline by 5%. And then in worst case scenario, we expect to use a lot of borrowings. So we can even make borrowing to rise by 15%. Or sorry, 10%. And this 10% we are doing here is 10% over and above whatsoever base computation we did, right? Above base. So this will be above base. And this also will be above base. So they are above base, but it depends on the direction, right? Whether it's going to positively above or negatively above and all that. Above base. So this also above base. Okay. Now, so we define the first ones. The next thing we want to define is for the loans. And once we're done with the definition, it's a matter of just linking and we are done. So we'll do for the loans as well. So for the loans, gross loans, we will say that, and advances, right? Now, we will say that gross loans and advances, the base case, then we have the rest as well. The base case, nothing is added because base is base. But for the gross loan category, in a best case scenario, we want something above base. In a best case scenario, we want to create more loans, right? So we can do additional, maybe 6% or maybe even 10% increase in loans. And there's a reason why I'm bringing this 10% above what we forecasted. And in a worst case scenario, this we expect it to worsen, right? In the worst case scenario, this is also above base. In a worst case scenario, we will not be creating loans, so the loan creation is going to reduce. So we do maybe 5% reduction in a worst case scenario. 5% reduction in a worst case scenario, or maybe even 10%, maybe 7% reduction. Let's work with 7% reduction and see. 7% reduction, a worst case scenario. Okay. Now, the whole thing is that once we do that for gross loan, if in a worst case scenario, you don't give out the loan, where is it going to? It go to investment securities, right? Investment. So you're going to be giving it to the government. That's the whole idea. So we have gross investment securities, gross investments, the base, we do nothing about that. Gross investment here as well. Best, and then we have gross investment, West. So gross investment base, nothing is done. Gross investment best year, the best year for for investment will be a situation whereby we don't create much loans. If we don't create much, in a best case scenario, we don't invest much in investment securities, right? So in that case, let's say investment securities will reduce by, the investment in that will reduce by 3%. In a best case, if we don't invest in investment security, but in a worst case scenario, we move a lot of money to investment securities. So we can do that in a worst case scenario to be 10%, 10% growth above what is projected in a worst case scenario. Good. Maybe not, yeah, 10% positive, right? Or maybe we can do it 7%, 7% or something, yeah. Above what we are projected, above what we projected. Now, so we've done with customer deposit borrowings, gross loans and advances, investments. Someone may be thinking about, hey, in bad times, don't you think that companies are likely to default on their loan commitments and all those kind of stuff? And I'll say yes, that is true. I want to see. There's an error here, right? How we working with the scenario triggers here for investments is actually supposed to be the ratio of loan to investment, or loan to investment ratio, right? Investment. It should be loan to investment ratio, guys. Not because we are not actually forecasting the investment securities directly, if you recall. So it's loan to, so actually gross, what we're doing is gross loans to gross loans plus investment. This is how it's supposed to actually be. So we have base, we have best, above base, and then we have in west, and this will also be above base. Okay. So what happens is that this is a ratio rate forecasting, and in that case, if we are saying a best scenario, means is the time that more loans are created. If more loans are created, then the loan to this ratio will rather be higher. So we make that rather 5% above. And in a worst case scenario, that's when we don't create loans, we ever move to investment securities. So this will be 7% above, 7% below what we currently have. So that will be negative 7%. I just corrected myself quickly. Now, so I stated something that the issue of the maybe credit quality declining in bad times and all that. What are we doing about that? For the purposes, the decline in credit quality, for the purpose of impairment calculation, we have the distribution of credit quality here. And what we can do is that we need to do it such a way that in bad times, things change, in good times, blah, 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 like that. Maybe what we can do is this, because this is a key aspect, right? So the impairment computation tend to change because we need, these allocations actually help us in the computation of the impairment. So if I bring this to the triggers here, let's see how it's going to look like. It's an area that will be a bit confusing if we are not careful about it. Because the reason why this may be a bit confusing is that if we have, let's say, current as percentage of total gross loan, I want to say that, let's say, in a good time, that increases, in a bad time, it declines, and all that kind of stuff. How we're going to do this particular site actually is that we are going to say credit by credit quality, and then this will be, we know the base here already, so all we need to do is to do the best case, and this will be, let's say, best case, and then we will do also for base case, for worst case. That will be how credit quality will be handled, worst case. We will not repeat base case, right, guys? We don't have time. Base case, nothing changes, right? It's still the same as what we initially have. So how would the best case be? We want to do it such a way that in a best case scenario, a lot of loans will not go bad. So in a best case scenario, currently best case scenario is around, base case scenario is around 80%, whatever. So we'll do a 3% or a 5% addition. So let me show you how that way we do, how we handle these sites, right? So do 5% addition here, and the total additions you are doing, adjustment you are doing, should sum up to 0. So this is increasing by 5% in a good time, and this is increasing by 2%. This is, I need to be careful with the base, the way the base is. This is going to decline significantly. You make this decline significantly by some 6%. 6%. Okay, good. So the total decline should be 6%. Now, what I want to do is I want to say that in a good time, the loss will decline significantly by 5%. Let's say by 5%. So the loss will decline by 5%. So I can make this to improve by 3%, or maybe 4%, and this will improve by maybe some 0.5%, and this 0.5% here as well for the second one. The rest can be the way they are. But the total must be equal to, the total must be equal to 0. The total movement must be equal to 0. Otherwise, your model is wrong. So we do this. That is in a good time. But in a bad time, we are going to reverse it. Rather, this will increase by 5%. In a bad time, this will decline by 4%. In a bad time, this will decline by another, maybe even to say this will decline by 0.5, decline by 0.5%, decline by 0.5% so that the total movement is to 0. Okay. This also done. Good, 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 good. Not applicable. Let me just do that also for this one so that we know this one's also filled with not applicable throughout. And then we copy the same thing and paste it not applicable. Now, you ask me, are we going to do for everything on the balance sheet? No. The key things we're interested in are the investment, the borrowings, the deposits, and those are the key things. The rest on the balance sheet, like assets, I mean fees, assets, and all those kind of. We don't care about that in the scenario analysis, right? Then we move to P&L. On the P&L, it's going to be easier. How the scenario is going to work on a P&L. On a P&L, what we are going to do is that, let me check. I provided a form of a guide by me here. On a P&L, we're going to look at, let's say, interest income. Interest income, I need to put here interest income, this for the base. Then I have interest income for West and the other ones. So this for best, above base, and then this will be for West, above base, and then this for interest income. So let's work out interest income and see how interest income is going to be like. Now, the yield on the asset is what we are concerned about. So we can do a 2%. Well, for base, we know it's going to be 0, 0, 0, nothing above that. For interest income best, it will be a 2% above. Let's do a 2% yield above the base, a 2% yield above the base, yield on asset. And for interest income, let's do, for the West period, let's do maybe a negative 3%, okay? Yeah, so 3% below base. Let's do something like that. Now let's move to interest expense. Yeah, slow by short, right? We will be done soon. Interest expense. You have interest expense. So interest expense, we change all this to be expense. Interest expense. And finally, expense here. Now, in a normal time, we don't adjust because we have the base case model, right? In the best period, what we do, the best period, let's do, it means interest cost is going to be lower, right? So in the best period, let's adjust things by maybe 0.2, right? 0.2 in best period, 0.2 reduction. So reduction of 0.2 in best periods, and let's drag that through. And then in worst periods, where there's flight to safety, right? West periods, a lot of people are flying to, and because of the difficulties in the, credibility of these banks and all that. So that's where most banks would like to go for expensive deposits, right? And all that. So in West periods, let's increase the interest cost by 1%. In West period, we increase it by 1%. Now, what is left to finish this? Let's look at the other operating expenses and income. So the key ones, like all the operating expenses, we are treat all of them together. Operating expenses. So in good periods, so the operating expenses here, I'm going to put here, it will include things like personnel expenses and other expenses. Personnel expenses and other expenses. So these are the things we are going to handle. So we have operating expenses. And then here to operating expenses. Then the final one, operating expenses here. Operating expenses. Okay. Now, so let's check it out. So in good times, in normal times, of course, no adjustment. But in good times, there will be efficiencies, right? There'll be efficiency. We expect some level of efficiency in good times. Because of level of efficiency in good time, let's say there will be a 3% maybe decline, 3% decline in operating expenses generally, and then but in bad times or worse times, let's say there will be 8% increase in cost, 8% increase in operating expenses in bad times. The last thing to do is the income component of things. Let's do the last one, and then we are done. The first, for the income, you know what I'm going to adjust, because the income projections, we've been doing it based on the growth in non-funded income. So I'll do non-funded income. Then that ends it. Non-funded income. Then we just link our things, and then we get out from here. So I have non-funded income. So I have, let me just present it here as well. Non-funded income. So I copy here, delete this side, come here to delete this and paste it here, non-funded income. So non-funded income in good times, it means that we're going to make more money, right? We'll get more money coming to us in good times. We'll get more money coming to us in good times. So we can expect that in good time, you have some 5% above the projections. So 5% above the projections in good time. And in bad time, let's say we have a 3% reduction, 3% reduction in our forecast. So we have this. Good. We have our scenarios here, our scenario triggers. Maybe you have never seen these things like this presented this way, but of course, in the market, some of us tend to do things this way, right? To bring in place some discipline in our modeling. So we know the base case already. We go straight to the best case and make the necessary adjustment. So current accounts, look at what I'm going to be doing, guys. I think there's a question. Please correct the last scenario trigger. The last scenario trigger, you didn't drag. Oh, okay. Oh, thank you. Thank you very much, Tony. Last scenario trigger, which I didn't drag. Oh, really? I think I did. Oh, I see. You have corrected it. Yeah. Sure, I did. Thank you very much. Thank you very much for the observation, actually. So best case, look at what I'm going to do, guys. This is the best case scenario worksheet. I go here and I already have some things here. I need to delete them. I don't want to make any mistake. I need to delete them. And then excuse me, there are some things that I may not need to delete. I'm sorry. There are some things that need to be the way they are. I need not to delete them. I'm sorry for deleting things without thinking through. They should be like this. There are some that are going to be as per the base case model. It's just some scenario. There's some things we're including in the scenarios. The first one is the deposit. So those ones, I can delete them entirely from here. Then I need to build them now. So what I'm doing with this is that I'm taking the base current account growth, And then we ask ourselves, which scenario are we working with? He said we are working with best case scenario. So if that's the case, we say we are going to add some things to it. We go to the scenario trigger and then look for deposits. Are we in deposit? Yes. So go to best case scenario, base case scenario, pick the deposit. Then we say in good times, right? So we go to the trigger and look for best case. And we say this is what we are going to add to it in good times. Because I want to drag down, I'm going to log this row for the scenario trigger. I'll log the row, hit enter, and I have this. I drag it down to even time deposit, and then I drag it to my right. Then I'm done. So that is done for deposit. And deposit model is, the model is automatically adjusted once I select that in the drop down button. I come to the same deposit here as well. The same thing is going to happen here. So one thing I can do is that I can even copy this and paste here. It will still give me the same thing. If you look at it, it was 9.8, it's now 15.8, right? It has adjusted. 8.4 will change to 14.4, right? Good. Because my worksheet is arranged properly. And I'm saying that, and deposit from banks and other financial institutions and customer deposit are all the same thing. They're all doing the same thing, right? This is what I have. Now, borrowings here have a different one. And so I go to the base case model and I pick the borrowing I have here. Then I'm still in best times. I'm going to add whatsoever is in the scenario trigger. Scenario trigger says that in a best case scenario, deposits or borrowings will drop by 5%. Let's hit that. Yeah, let's drop by 5%. In the best case scenario, delete what I have here, then continue. Now, gross loans, we are still in best case scenario. So we go to the base case, we pick whatsoever is gross loan in the base case, and then you see that the arrangement of things here, things still follow, right? We then go and add the scenario trigger for best case under gross loans. And here is it, 10% above base, 10% above base. We need to lock it. We need to lock it, and then you lock the rows. So I can drag here. No, I think there's a problem. Oh no, there are no problems. There are no problems. There are no problems. Because if you look, okay, there are no problems. There are no problems. This above base. Okay. So we have this. We have this done here as well. The next thing to do, we have the loans, gross loans and advances, distribution by credit quality. Distribution by credit quality. Let's see how this has been worked on. We are going to this one to delete it. And then we go to base case, pick that of base case, and then we go to the scenario trigger, and we are looking at the credit quality. So we have this here. And so we are adding it to it. We are adding it. And if you look at it, I can just drag, right, for the best case scenario. So when I sum up, it must be 100%. If it is not 100%, we are wrong. Guys, let's check it out. 100%. Good. 100%. But you see that this distribution is going to be different from the one we see in the base case, right? Then asset allocation. So asset allocation too must be worked on. We go to the base case and pick the allocation, the ideal allocation. Then we say we must adjust it depending on the case. So we go to scenario triggers, and the asset allocation here, gross loan to gross loan plus investment security. Best case scenario, we add it to it. Then we enter, then we drag. And what needs to be changed? Investment security growth will, this is the percentage distribution. We are not changing that. Gross advances to banks. Okay, this is also part of the loans, right? So the loans, we go to base case scenario, gross advances to banks, and then we adjust it by scenario triggers. The triggers here what will trigger in here will be gross loan and advances best case. So we add that to it. Then we drag. Good. Allowance for this one is a BOG regulation and it's constant, no matter unless there's a regulatory change. So we are not changing that one. Things like non-pledge, I'd say we don't care about that. Investment other than security, we don't care. Investment in associates, we don't care. So all these ones will be as per the base rate, the base assumption. So I'm going to do something quickly now. I'm going to use the base assumption for all these things here. I'll use the base assumption for all of them. I'll use the base assumption for all of them. So I have that consistency. I don't have some things growing at some rate and some growing at another rate. Then I have for investment in associates as well. Investment in associates, I have that here. And then the last one is investment in subsidiary. Investment in subsidiary, I have that done. And then there is something I want to do here. I want to link even these ones all to the base case. Even to the base case, right? I'm linking it to the base case assumption. And what is happening to my Excel? I don't like a situation whereby the Excel keep freezing in this manner. It's annoying, right? To have my Excel freeze. When I'm doing very important things, then the Excel is freezing. Okay, so I can copy the links. The things are all synchronized, so I can copy and paste and still be fine. Okay, all right. Asset allocation, funding, blah blah blah. Okay, everything is in order now. So I move to the next thing, which is CAPEX. Of course, let me just link it to the base case. The base case, and is as per. Let me change this to okay. Then let me do this also. I've arranged my sheets so I can just copy and paste, and the formulas will just be updating everything. And that's how beautiful the whole thing is. If you do your things well, you arrange your formula. That's why it's always good to build your model initially with a base case, and then you duplicate that sheet, right? So all these things, I'm not drawing any scenario around them. They are as it is or as they are. No need for any scenario planning around them. No need for any scenario around them. No need for any scenario around them. Wonderful, wonderful, wonderful. I don't know. Just a moment, guys. I don't know whether there's a problem with this one, but let me just go to base case and look for employee obligation and bring it here. Yeah. Doing that won't hurt me. Now, dividend policy, nothing is said around that. Dividend policy, nothing is said around that. Interest income yield, that's another side. So interest income yield, we're saying that you go to base, you pick that of base, then you add the scenario trigger. The interest income yield scenario trigger. So best case scenario, this is the interest income yield. You add best case, you add it to the best case here, and you hit enter here. But then we need to lock the trigger so that we can drag it across, okay? We need to lock the trigger and then drag it. And then we have here. Then the non-funded income ratio, we go pick the base case, then we add the scenario trigger to it. So where is it? Non-funded income ratio. We add a growth rate, we add that to it, the trigger to it, and then it gives us the growth. The growth here. Fee and commission income they will all automatically update, right? They will all automatically update. So I just have to go pick the one in the base case, and that's it. Their ratios to the whatever will not change. All that is important in the scenario analysis is the growth, the overall growth in the non-funded income. The rest, the base case assumptions will work accordingly. So the base case assumption will work accordingly. So other incomes. So I'm linking all those things to the base case assumption, right? And then the interest cost is another area to look at. So that one, you go to base case, you pick the interest expense, funding, whatever. Then we add the trigger. The trigger, interest expense trigger, in good times will reduce. So we do that, and we are going to drag it down. We'll drag it down, actually. So we need to anchor it. So you can see that in a best case scenario, it has reduced by 0.2% as we expected. And then fee and commission as percentage of whatever will still remain the same, because that is just a ratio, right? Once we determine the fee and commission directly, those things all will change. Yeah, those things all will change. And then the next thing is personnel expenses. And we said all these expenses will also, we apply the same to them. So we go to the base case scenario and we look for personnel expense, and then we add the trigger to it. Go to scenario triggers and look for operating expenses in good times, and then we drag. The other items below it will remain the same as, the ratios will remain the same as in the scenarios, as in the base case scenario. Good. Then finally, we have this one, the other operating expenses. We pick the base case in this scenario as well, and then we add the scenario trigger to it. And then scenario trigger to it, which is this. In a best case, oh, sorry. I know I made a mistake. In a best case, this is what we have. Then we drag. Good, we are done. We are done with this. Now let's check what is going to happen. With all this we've done, let's check it out. So let's look at the performance analysis. We are still on the base case, right? Let's change the base case to best case. It has calculated. Oops. You know, you can actually plot. So with this, you can actually plot the graphs. Non-performing loans, not applicable. Why? What happened to non-performing loans? Guys, it looks like the best case scenario, we may not even have non-performing loans. I don't know what's happening there unless we check. But if you look at the best case scenario we have here, and just to say, we are not going to do a worst case today, okay? I'll do the worst case. Since I've taken you through the best case and the base case, I'll do the worst case. It's just an Excel work, right? I'll do that before Monday, and then you'll see some graphs and things also plotted before Monday class. I'll have those things plotted just to show to you, right? So let's just conclude on what we've done on the best case now. So if we look at the very things we've been discussing, like some critical ratios like earning asset yield, let's look at net interest margin for best case. Net interest margin for best case, a little above the range in most cases. But if you look at the industry, it still sits within the industry. Industry ratio is 11.3% to 70.2. Look at this one. It's not too bad, right? And if you look at loan to deposit ratio, oh, it's still cool. I'm so shocked. Loan to deposit ratio is still cool, because if you move this to base case, just by the loan to deposit ratio, this region, let me paint it red. I want you to just check something here. Loan to deposit ratio here. Check it out. Let me move from best to base. You see that? And I go back to best. Oh my goodness. I love these numbers. I think this is just beautiful. I think that's just beautiful. So I'm coming. I want to. I don't know why this. Okay, it's working now. Okay, so this is good. Then the cash to deposit ratio is higher. I'm not going to adjust this because it's not too bad, because it still sits within the historical average, right? Or the historical range, so it's fine for best case. And then let's look at return on equity. Return on equity for profit after tax is this. Not too bad, not too bad, not too bad. Even return on assets, because this is best case scenario. It's supposed to be very good. The problem I have now, which I have to settle before we close to find out why this problem, is with the NPL ratio. Let's check something quickly on the NPL ratio. So earning assets, you go to earning assets and check what is happening with the NPL ratio. Non-performing loans. So we are here. Oh, it's not calculated. Why is it not calculated? You see, that's what the problem is. Why is it not calculated? So there's nothing here. Now, I don't know why this is happening, but let's check something quickly, because that's the last thing. Then we close, guys. Let me go back to the assumptions, right? Base case, best case scenario assumption. Let me check that credit distribution. No, we have it. So why has it failed to work? Why has it failed to work? Okay. So let me take this best case scenario and place it just by the earning asset, so I can sort out this issue. So this is a formula. Let me go to the live page. The live page. Oh, look at the live page. The live page is 00 throughout. How could this be 00 throughout? No, there's a problem. I don't know what's happening to the switch function, but there's definitely a problem here. There's definitely a problem here. I think there's a problem here. Let me just rework on the switch function. Switch, I am picking this here and I'm anchoring it. And then I said that if this is base case, then I'll go and pick base case. I'll go and pick base case. If entered few, okay. Oh my goodness. Base case. Then I'll go and pick base case. I'll go there and pick base case, which is where's this? Delete. Where's this quickly? Okay, here is it. I'll pick base case. And I said, if this is best case, then go and pick best case. So I'll go to the best case worksheet, which is hidden somewhere here, and go and pick best case. And we say, if this is worst case, worst case, then go to the worst case sheet and pick worst case. And we are here on the worst case sheet, and we want to pick the worst case scenario. Where are these things? Okay, good. I have it here. Worst case. But worst case, don't forget I will complete that on my own, right? So we are on the best case. So this is what we have. Yeah, so now it should work. So let's go back to, my figures are going to change, right? The objectives. So you see the non-performing loans. Guys, can you see what is happening? In the best case scenario, see how the non-performing loans has improved. And then in the worst case scenario, you see how the in the best case scenario, let's see the non-performing loans in the best case scenario. In the best case scenario, 15.3%. But in a best case scenario, it is 10 point something percent. I like that. I like that. And the gross loan to whatever ratio has improved. Loan to deposit ratio has improved. Oh, now we see our cash to deposit ratio after we've now done all the adjustment. Look at how beautiful it's sitting here. Our investment in equity, return on equity has been really good in the very best year for GCB Bank. It's been a great night with you guys. We've done a lot, right? And I believe you're all happy with the work we've done. We have the best case and a base case model built. And I promise you that I'll work on the worst case model. And then I'll have some graphs also plotted along the way. And then we'll have that to form the basis of our valuation on Monday. So Monday, we'll do discounted cash flow valuation, or discounted profit valuation. And that also will include residual income valuation and all that. Then Tuesday, we'll do relative valuation, which has to do with the market multiples. Wednesday, we'll put everything together and do Monte Carlo simulation. So around Monte Carlo simulation on the valuation figures, so you see the distribution of the bank's value in the future as well. So that is how it's going to be in the next 3 days that we're going to be doing this, right? I'm happy that you've been here. It's been amazing. I'm actually joining from Canada. That's beautiful, Tony. I'm happy you've joined and you've learned a lot. I hope I find a time to join. Yeah, try and join. Thank you very much. Thank you very much, everyone. Oh, well, it's been a roller coaster. Put something in the chat. Ibrahim, Isaac, Sedinam, and Tony has put something there. Ezekiel, let me hear from you. EA, let me hear from you today. Today, I want to hear you. I want to see you writing something. I've never seen you writing anything before. I've been calling all the time, so let me hear from you today. But guys, I hope you have really enjoyed the session. And for today, we have an optimized balance sheet and P&L cash flow for both best case and just for you to see. If you check the financial statement, we are still on best case. You see how best case is looking at, and you see best case P&L as well, where the bank's profitability will be in a best case scenario as well, and best case cash flow statement. You can see that all done here. Okay, and it's in balance. That's a beautiful thing, right? Sedinam, very insightful. Thank you. Yeah, great. Thank you very much, Sedinam. Guys, thank you very much for joining. Over to you. Over to you, Ifri. Ezekiel, thank you. Ibrahima, always the same energy. Thank you very much. Let's hear from you. Yeah, good. Today I've heard from you. Thank you very, very much for taking your time to go through every aspect of the value. Thank you. Thank you. Okay, Ifri, are you there?
Yes, I am here.
Okay, good.
We have made it through the week.
Yeah.
Yes. Thank you so much, Julius. And everybody on the call, we would continue on Monday. I would, Julius, will you be sending me any documents to share with them before the call?
Yeah, I'll share. So what I should do is that I need to optimize that model
Okay.
I need to do for the worst case scenario as well, and plot those graphs, and then I'll share. And that's what we use for valuation. So I'll share that.
Okay, sure. All right then. Okay. Thank you, everybody, and enjoy your
You're
weekend.
welcome.
See you on
Thank you.
Monday.
See you.